Hi Hardik, welcome to the show.
Yeah, thank you.
Today, the India macro is quite interesting for a lot of private equity investors, and that's largely to do with two factors. One is growth, and the second is relative growth. So effectively, India is well poised today relative to some of the other geographies because from an investor perspective, typically these private investors have the ability to take exposures in multiple jurisdictions, multiple countries. And India today, from a relative perspective, is garnering a lot of interest. Now, within the real estate, the typical four sectors, the first one being data centers. Data centers is, today garnering a lot of interest from investors. And that's largely to do with the macros that are playing out. I mean, if I have to give you a little bit of a deep dive into this, today India is a young country. We have access to mobiles, and access to internet is to the cheapest by far worldwide. And as a result of this, what is happening is there's a lot of data generation, and today data is critical for these AIs. And now these data have to be stored, and these get stored in data centers. On the other hand, from a supply perspective, there is very limited supply in India. If I have to contextualize this, India today generates data equivalent to a US and a Europe together. Both US and Europe together, that's the amount of data that India generates. And as compared to the existing stock of data centers, India has close to 1 gigawatt, and this is 1/12 and 1/15 of US and Europe. That's the kind of scale that this business has in India. And we continue to look at this sector very closely. The second one is office. CapitaLand, as you know, has been in office for 30 years. That's the mainstay. It always goes back to fundamentals. And the fundamentals is the availability of engineers, the availability of doctors, availability of chartered accountants, effectively our workforce, which is available not just in terms of scale, but really come up in terms of quality. And that continues to generate demand from GCCs as well as domestic consumption-led companies. So office, as we know, last year was a record leasing year. It's significantly higher than pre-COVID years. So we continue to look at this sector from a private equity perspective very closely. Third one is logistics, especially after the GST, the goods and services tax that got introduced in India. Typically the earlier logistics were located based on tax benefits. Now, because it's one country, one tax, those have been reshuffled. And effectively, the quality of the space that being provided is very, very critical. So that's why we are seeing a lot of the grade B stock now getting converted to grade A. It used to be a 80-20 split. Now it's more like a 50-50 split. And still there is 50% which is grade B, and there is headway for grade B to get converted to grade A. So that's number 3. Now, what does it mean from an investor perspective? Effectively, investor is looking at these macros and taking a bet on what would be the future valuation and how does it stack up in terms of risk returns. I would say broadly speaking, all three sectors continue to garner interest among LPs. So the fourth sector, of course, is residential, and residential is one of the largest markets. We are not in the residential sector, but that sector is also garnering interest, especially over the last couple of years. We have 4 funds we are currently managing in India. 2 of these are office funds. The first one was a 2014 vintage fund, which is now fully deployed. In fact, we are looking at certain exits there. The second office fund is the one we closed last year. We raised $525 million. Now, mind you, these are Singapore million dollars. On the logistics side as well, we have 2 development funds. Fund 1 is fully committed. Fund 2 is 85% committed. Each are close to $400 million. Now, once Fund 2 is fully committed, which should happen pretty soon, we are looking at raising Fund 3 for a development strategy.